Good morning, everyone watching live on BAM YouTube. Let me know in the comments where you are tuning in from. The Hot Sheet covers what you need to know about the real estate industry in a 24-hour time period. On today's Hot Sheet, I will discuss pending sales, Fannie Mae's home sales projection, investors losing money, mortgage delinquency, and wage gains. Today is Friday, April 28th, 2023. I'm Byron Lazine, and the Hot Sheet starts now. All right, hit the like button, and thank you to everyone who did sign up for BAMX yesterday using the Hot Sheet code. There's a link down below. It's 15% off. Today's the last day. We just soft launched it this week, and it is by far the most valuable subscription in the real estate industry that you can obtain. So go check that out. I'll make one final offer here before the end of the show. Pending home sales decreased 5.2% in March. So NAR released this yesterday right after our stream. Pending home sales dropped in March, down 5.2% from February. So this shows you more inconsistencies in the real estate market. You know, we can't be that agent that is saying, homes are, more homes are selling, sales are up, the market is crazy. That's the worst thing to say. The market is crazy. The market is complicated. The market is very complex right now. Month to month, things are changing, and certain portions of the market are strong, and then others are dropping back. And home sales dropping from February to March typically doesn't happen, but did happen across the country at a 5.2% level. Month over month contract signings fell in 3 U.S. regions, but did increase slightly in the South. So your local market may be one of the markets where you've actually seen pending sales increase. Let me know in the comments if that's the case for your particular market. It's certainly not the case for every market or the majority of the country, because overall it's down 5.2%. Pending home sales retreated in all 4 regions, of course, from 1 year ago, year over year. Pending home sales would be down. We'll take a look at all of the regions here in just a second. The pending home sales index that's put out by NAR. This graphic that I'm about to show, as well as the source, as all of our sources, will be down below in the daily download for Hot Sheet Daily Download, absolutely free. Sign up once, you get every single slide and daily and source that we do every single day sent directly to you. Forward-looking indicator of home based on contract signings waned by the 5.2% to 78.9 in March. So that's the index, the 78.9 reading. And then year over year dropped 23.2% year over year. An index of 100, again, we've talked about this in the past, but an index of 100 is equal to the level of contract activity in 2001. Okay, so we're at 78.9. We're 20 plus points below contract activity of 2001. Shows you how low our total sales have dropped. We're trending somewhere towards 4.44 million sales for the year, well off of the north of 6 million we experienced the last couple of years. Let's take a look at these regional numbers. I'd love to know in the comments what your market's looking like. Jody says our market, she's been seeing increases week over week. Any given week, it's well over 200 plus, along with 200 plus new listings week over week. OKC market. And I guess those numbers are considered gains from Jody's data in her MLS in that OKC market. We know OKC actually has new construction under 300,000. So that wouldn't surprise me that we're seeing home sales go up in a market that actually is providing a new construction product below 300,000, when the average sale price for new construction is 550,000 and the median is 459. The numbers in OKC just completely blow my mind. Okay, so housing snapshot here for these pending home sales. Again, the index is 78.9. Month over month, we're down on total sales 5.2% across the country in the month of March. We're not up, we are down. Okay. The Midwest saw month over month declines in total sales at 10.7%, while the West saw declines in month over month sales at 8%, and the Northeast saw them at 8.1%. Northeast being the region most starved for inventory. Okay, the South, which does have an uptick in inventory, saw month over month sales increase 0.2%. The South being by far the strongest in comparison to total sales when you look at the 100 level index relative to 2001. The South is coming right in at that number, basically at 99.6. The West is coming in at a putrid 59.4. The Northeast is at 66.6. Scary number there. And then the Midwest is at 75.7. So the South is really pulling up, the Southeast is pulling up the rest of the country in total sales. That index across the country of 78.9 would be significantly lower if the South wasn't at its 99.6. When you look at the West and the Northeast being dramatically lower than the 78.9. So these numbers are just well off of what they consider normal sales activity of 2001. William Burton from Charleston. I can't read it when it's up for 1 second. Consistently seeing 300 plus pending home sales down from 2022, but consistently above the 15-year average every week. So that's in Charleston, South Carolina. Obviously, I think everybody's below 2022, but seeing strong numbers in relation to the average there in Charleston. So good news for the Charleston market. Matthew from Nutley, New Jersey, we are still seeing massive bidding wars. Just sold a home at 111 over ask. Okay, and so I get that. You're seeing massive bidding wars on the inventory that you have, which I know in New Jersey is limited. But is the market seeing total sales increase or decrease? Take it from February to March, like this index is showing us here. Because these anecdotal examples of bidding wars or 20 people standing outside of an open house or whatever shows me that inventory is limited. It doesn't show me that sales are increasing as we go into the spring in that market. From February to March, the median price point went from 520 to 600. Absolutely another indicator that there's just not a lot of inventory and the demand is outpacing inventory, right? Across the country, we have 2.6 months of supply. Market is seeing total sales slightly decrease as a whole, but limited inventory is so low. So there you go. And so that's reflective of this Northeast number right here. The data that Matthew just gave us here for New Jersey, that's reflective of month over month sales in the Northeast being down 8.1% in the Northeast, down 10.7% in the Midwest, down 8% in the West, and then just basically flat or slightly up in the South and Southeast. Knowing that number, sales month over month in your particular market, is critical. We want to avoid, there's a clip out there from Jared James, friend of mine in, he's Jared James Today, I think, on Instagram. Anyways, the clip where he's talking about, agents are talking that this market is crazy, that it's insane, that there's, insane activity. And he uses the example. People don't want to get into a relationship with a crazy person. Okay. They don't want to have a discussion with a crazy person. That is scary to them. They want to run away from crazy. Okay. The market does happen to be complicated and complex and competitive. Those are the words that Jared used. So I'm kind of riffing off of what he said. But we want to stay away from crazy and go into data-driven examples. Sales are down from February into March here in New Jersey or here in, whatever market. And it's more indicative of the low inventory because we've also had inventory decline at a faster pace than sales are declining. Here in these price ranges, we're seeing home values actually increase, right? And these are the data points that we want to use to dispel the headlines, because somebody's going to read a headline that says home sales are down, pending home sales drop, because that is, an accurate headline as this information released from NAR yesterday. That would be an accurate headline. Home sales drop. But in the everyday consumer's mind, that means home prices are dropping. So we've got to go a lot deeper in that. Nutley is a need-based market, meaning 100% of sellers are leaving the state or retiring. We know Florida, number one inbound migration state. I wonder, Matthew, are you seeing them go to Florida? Are you seeing them stay in the Northeast and maybe, go somewhere else? Where are you seeing them go? Dawn from North Texas, median price in February was 360,000, and in March is up to 362. Love to know, Dawn, are pending sales from February to March in North Texas up or down? The South, it was up 0.2% overall. Love to know what North Texas looks like with those median price points. Maybe up if you have the inventory. If you don't have the inventory, maybe not up. Okay, so let's take a look at what's going to be projected for home sales going forward. This is according to Fannie Mae, and I'll be reading from a Housing Wire report. Home sales to remain subdued for the remainder of 2023. So these pending home sales declining would be an indicator that Fannie Mae might come out on this prediction correct. Housing demand, home prices were more resilient than anticipated in quarter one, but the rate lock-in effect will hinder home sales. Okay, so in addition to the lower mortgage forecast issues, so that we're projecting that we'll see a lowering of the mortgage rate forecast for the rest of the year. Fannie Mae's Economic and Strategic Research Group has upgraded its existing home sales outlook for the remainder of the year, still at an expected 4.2 million. So they're below NAR's number last week at 4.44 million existing home sales. They're only at 4.2. That means there's only 8.4 million sides. Still a lot of sides. I say only. I should remove the word only. But well below 12 million sides that a lot of agents got comfy on the last couple of years. Okay, so an expected 4.2 million sides. The existing home sales forecast represents the slowest annual pace since 2010. Just a side little rant here for real estate agents on the live stream. If we're used to an environment where we had 12 or 13 million sides, and now we're going to experience 8.4 million sides, that's like 30-40% less sides, less closings, less commission checks, whatever word you want to use. Should our output on follow-up and relationships and adding to our database not go up 30-40%? Let me know in the comments if you agree with that. The economic slowdown has resumed. Whether the end result is a modest recession or simply a soft landing remains unanswered, although we continue to expect the former, as we have since April of last year when we first made our 2023 recession call. Okay, so with upgrades to both home sales and home price forecasts, Fannie Mae adjusted its forecast for mortgage origination upward. Good. Okay, so essentially they're 4.2 coming in lower than NAR, and they believe that these home sales are going to continue to decline throughout the year as we move through the spring and into quarter three and quarter four. Okay, so that's just Fannie Mae's projection. 4.44 million would be NAR's. But they believe that these sales are not going to increase as we move throughout the year, that they will actually continue to decrease. Matthew, back in Nutley, New Jersey, plenty of realtors that got licensed during COVID have been leaving. Yeah, of course. They've been, that's certainly true. And so there are more opportunities. And I say that to new agents that are entering the business in 2023. They feel like they missed the boat. I said, you didn't miss the boat. You've got a great opportunity, because the agents that were in here for the easy commissions are on their way out. There's no better time to build a bigger business than in the down market. So I would definitely agree that that's a great way to look at it. Investors are looking at this market with a confusing approach. Redfin reports that 1 in 7 investors are losing money. This is on nowbam.com, but of course it'll be linked down below in the daily download. Okay, a new Redfin report finds real estate investors lost money on about 1 of every 7 U.S. homes they sold in March. Okay, so that's 13.5% of investor sales in March. Investors lost money. Let me know if you were one of those investors. Maybe you don't want to let me know, or if you worked or advised or consulted with an investor who actually lost money with a sale in March. Okay, so February Is 14.5% of investment sales lost money. These are the worst rates since 2016, largely due to these high mortgage rates basically shrinking up their margin, right? So for context, 4.8% of overall U.S. home sales that closed in March sold for less than the seller originally paid for it. So about 5% of total sales sold for less. But when we look at just investor specials, that number is 13.5% for March, and it was 14.5% in February. I have a chart that outlines this. So if you're working with an investor this weekend and they want to YOLO and roll the dice, and you're like, hey, I don't know about this particular property, you could show them this chart. Okay, U.S. real investors lost money. Roughly 1 out of 7 homes they sold in March. That share sold at a loss, 13.5% is the top graph. You can see that higher than any point since 2016. Prior to 2016, we obviously see the huge over 60% of investors losing homes back in the GFC. Median capital gain was 146,000. So the investors that are making money still making quite a bit of it. And then median capital gain percentage, again, the ones that knew what they were doing, had a big enough margin to make a profit, those made 45.9%. That's a Redfin chart that you can grab down below in the daily download to help with your personal investments or helping investors navigate this complicated, complex market that we are experiencing in 2023. The complicated, complex market doesn't mean that people are being delinquent on their loans. Actually, it means quite the opposite. And that's why this market is complicated and complex and very different, because when you hear a down market, you would expect that things are going to be like 2008, that people are going to be foreclosing and going delinquent on their mortgages. But that's not the case at all. Okay, calculatedriskblog.com released a report this week that Freddie Mac says mortgage serious delinquency rate decreased in March. Didn't go up, it decreased, it declined. So while people, I saw a report today on CNBC that 71%, I want to get the right number. So, oh no, I'm sorry, 73% of millennials are living paycheck to paycheck. So while people are just overspending right now, we know that credit card spending is going up and people are like buying more things than they need. Nobody is substituting their mortgage for the things that they're buying. People are paying their mortgage. I say nobody, almost nobody. Freddie Mac reported that single family serious delinquency rate in March was 0.62%, down from 0.65% in February. Freddie's rate is down year over year from 0.92% in March of 2022. March of 2022, home prices were peaking and the delinquency rate was higher then. As this market gets more complex and interest rates go up, less people are delinquent. It shows you how strong the mortgage borrower is today in 2023 in comparison to 2008. Freddie's serious delinquency rate peaked in February 2010 at 4.2%. We're nowhere close to that number, following the housing bubble, and peaked at 3.17% in August 2020 during the pandemic. So we had that short sprint during the panty when people were locked up like they were in jail in their homes. These are mortgage loans that are 3 monthly payments or more past due in foreclosure. Mortgages in forbearance are being counted as delinquent in this monthly rate. Interesting that mortgages in forbearance are being counted as delinquent in this monthly report, but are not reported to the credit bureaus. So the mortgages that are in forbearance, which is a couple 100,000 left, somewhere between 200,000 and 300,000 left, those are adding to that delinquency number. And something that we know about mortgages in forbearance, they usually get caught up and get out of forbearance without having any trouble. They have so much equity in their home. Why would they not get out of trouble? So that's actually inflating the number a little bit more, even though it's at a near all-time low. The serious delinquency rate was at 0.6% just prior to the pandemic. We're almost back to that all-time low level. Okay, multifamily delinquencies are on the rise because of the glut of supply coming out in multifamily. You can thank your government for that. Their goal for renter nation. They've been increasing, and we're at 0.13% in March, up from 0.08% in March 2022. So we will continue to see a little bit of a struggle potentially as more of that inventory comes on in multifamily. And when I say you can thank your government, you can thank the prior administration, you can thank this administration doing nothing but helping multifamily investors. And that's why we have that inventory and not the inventory that we need, which is single family units for good, hardworking Americans. Dawn, that is weird data that we all need to know. And in fact, Dawn, I've got down in the daily download, I've got a chart for you below for anybody that thinks I'm going to wait for these foreclosures. You ever hear a buyer say, well, I'm going to just wait for all of these foreclosures to hit? Well, good luck with that. Look at the delinquency rate. We don't have foreclosures coming anytime in the near future. You may be waiting a very long time. Here's the single family serious delinquency rate, and you can see that we are down at a level that we haven't. We're just hitting back to pre-pandemic level, but prior to the GFC, this is about as low as it gets for Freddie and Fannie on delinquency levels. Okay, so there you go on that information. Really important for people that think they're going to wait. Mom, my brother told me to, just wait for all the foreclosures to hit. Well, your brother is spending too much time on Discord and doesn't know what he's talking about. If you want advice from Discord, brother, go get some video games from him, but it's not going to be real estate. Okay, just like your brother on Discord or your Fox News uncle. These are not the people you want to get your real estate information from. It's the hot sheet. Hit the thumbs up. Tahir says it is a good idea to start an agency serving agents with. Is it a good idea to start an agency with content and media? Yeah, you're on it, bro. It's BAM. This is it. This is the media company for agents right here. BAM. Hit the subscribe button to here. Welcome to the world of BAM, where we are supplying the agents with the best media, the best content in the entire industry. Welcome to the club, to here. And if you want to sign up for BAMX, we got a link below for you for that. Key inflation gauge for the I'll take one more here. I hear that all the time. People think huge recession is coming. Yeah, this is Jerry. I'm sorry, Jerry. I had a hard time seeing a little bit here. Jerry, totally agree. Okay, so quick economic update here. Okay, so we had a key inflation data report today, a couple of them actually, and I just want to make sure I get them all to you so you know what's going on with that. Number one, First Republic stocks are going up. They're looking for a rescue deal. So it looks like somebody's going to come in and they already had a rescue deal, by the way. They got $30 billion infused, and they're now, imagine getting $30 billion and then needing a rescue deal after that. So it looks like we'll skip a catastrophe there with the banks, but we know that there's going to be more shoes to drop in banking down the line. Next economic update, we're going into an FOMC meeting next week. Okay, so we're going to see what the Feds do with the federal interest rate. I believe they're going to go up 25 basis points one final time. The market has priced that in. That remains to be seen. But wage gains today were reported as picking up as the Fed contemplates this rate decision of next week. Worker pay and benefit gains firmed during the first quarter of the year, but employers did spend 1.2% more on wages and benefits last quarter versus the prior 3 months, a slight uptick from a revised 1.1% increase in the fourth quarter of 2022. From a year earlier, the employment cost index advanced 4.8%, and easing from the 5.1% of the gain last year. Okay, so the Fed's preferred gauge of consumer inflation, the personal consumption expenditure index, showed that inflation cooled to 4.2% in March over the prior year. The Commerce Department said, so that's the PCE that you hear about. So it cooled to 4.2% in March over the prior year. That was cooler than the previous month, 5.1% gain, but still above the central bank's 2% target. Okay, so that was good. The wage gains, maybe not as good as we go into that meeting next week. Nobody knows what they're going to do. Again, the market's pricing in a 0.25% basis point, 25 basis point hike on the federal interest rate next week. We'll see what happens next week. That is May 2nd and 3rd. So I believe on the 3rd, we'll have that. Maybe not on the hot sheet, but we'll have it. Maybe he's going to talk on the 3rd, and then we'll have it on the hot sheet on the 4th. I'll be here in Naples all week next week. We've got the T360 Summit. So I'll be able to pull some stuff from that. You've got all the major prop tech and brokerage CEOs here in Naples going through the T360 Summit. So I'll give you guys some nuggets from that, of course, throughout the week of what's happening. We also have the BAM Mastermind on Friday. Let's see what today looks like here on this Friday for the 10-year and where we're at. Again, we went back up over 3.5 yesterday, and fortunately, we're back under the 3.5 mark today. We're at 3.467 on the 10-year. I would expect, if that sticks, that we will get a little bit of a drop from the week's high yesterday on the 30-year fix, which was 6.67. Okay, that's the highest we've seen. It's identical to last Thursday at 6.67. And hopefully we'll see this number come back down towards the 6.5 that we did experience on Tuesday of this week for the first time in a few weeks. So hopefully we'll be looking for the 30-year to drop down. And again, this is the last day on that 15% off BAMX annual. It has to be the annual subscription, which is down below. Become a BAMX member. It's your go-to platform for on-demand real estate education. We have BAMX courses every month. So a BAMX member of the team, myself, or right now, Eric, the broke agent, has the ultimate Instagram course. Those are going to be new courses uploaded every single month for a BAMX member, as well as live streams. Okay. And then you're going to get a discount off of BAMX creator courses. That would include Haley's Canva course. She's the founder of Coffee and Contracts. Okay. Or Tom Story's course, and many other courses that are going to be uploaded every single month. We also have a private community. The BAMX annual membership is literally $10 a month, and you're getting 15% of that when you put the code HOTSHEET into the link down below. It's by far the best community to be a part of. Listen, legacy media companies, they'll charge you $49 to read their articles. NowBAM.com, every article, every podcast, every piece of content is completely free and open for the entire industry. Then they'll charge you an extra, couple $1,000 for some video streaming thing where it's just people on stage that you've already seen before on YouTube. See, BAMX, we'll tell you how to do it for free in our articles and our YouTube videos. But then when you get on our platform for a coffee a month, or less than that, when you use the 15% off hot sheet code, which ends today down below, we're going to actually show you how to do it. Nobody in the industry is doing that, but we are, because we actually care. So give your coffee money to us and unsubscribe from any $49 crap that is holding your credit card back. I'm Byron Lazine. I hope you have enjoyed this week of the Hot Sheet. It is the only live show in real estate and in housing that is a daily show, Monday through Friday, 9:30 a.m. Eastern, 6:30 Pacific time. And until Monday, when I'm kicking off the T360 here in Naples, toodaloo. Have a good weekend.